Last night, Zoom released their first quarter earnings. First, we'll talk about their earnings results, then we'll go through their press release page by page, the first quarter presentation slides, and then the 10Q. Their fiscal year end is 1/31, so their first quarter ends 4/30. For the first quarter, they beat earnings by 17% and they beat revenue by 2%. Last quarter, which was 1/31, they beat earnings by almost 50% and revenue by 1.5%. This is their stock price for the last month. Their lowest point in the past month was on May 3rd. The stock was about $61 a share. Right before they released earnings, the stock did run up to $71. But there was a big sell-off yesterday, as you can see here. Look at this red line. When there's a red bar, that means the sell orders are higher than the buy orders and the stock price goes down. When there's a green bar, the buy orders are higher than the sell orders and the stock price goes up. I'm doing this video early in the trading day on the 24th. The market's been open for less than 2 hours, but the stock has come down today already a little bit. So far today it's down 3% the stock. The market cap is 19 billion. And you can see the stock is pretty close to its 52-week low. So if you do like Zoom, it's a great time to get in. If you bearish Zoom, then I guess I would just avoid the stock. As we all know, this stock did amazing during COVID. It literally saved my business. Look how high the stock ran up, almost $600 a share. I know lots of people lost money on this stock because now it's probably trading where it was during IPO. Imagine putting $10,000 into this stock and then before you know it, you have $300,000 and then you're back to $10,000. It would be really depressing, I know. Let's go through their earnings release report. This is for the first quarter of 2024, not the first quarter of 2023. If that doesn't make sense to you, leave a comment and I can explain why. Revenue for the first quarter was $1.1 billion, up 3% year over year. Enterprise revenue $630 million, up 13%. Their GAAP operating margins were 1%, non-GAAP 38%. GAAP is generally accepted accounting principles. The number of customers who spent more than $100,000 in a 12-month time period is up 23% from the prior year. That's a nice stat. Getting those big customers is how you move the needle. The company's CEO said the solid start to the year has enabled us to raise our outlook for fiscal 2024, while continuing to invest in innovations such as AI to help make interactions more meaningful and communications more effective. If that's not a bullish outlook, I don't know what is. First quarter revenue $1.1 billion, up 3%. After adjusting for foreign currency impact, it's $1.12 billion, up 5%. Enterprise value $630 million, up 13%. Online revenue $470 million, down 8%. GAAP income from operations $9.7 million, compared to the prior year of $187 million. Net income $15.4 million, 5 cents per share, compared to last year of $114 million, 37 cents per share. They have $5.6 billion of cash on their balance sheet. Operating cash flow $419 million, compared to $526 million in the prior year. Free cash flow $397 million, compared to $500 million last year. Free cash flow is operating cash flow minus capital expenditures. Capital expenditures are investments in property, plant, and equipment, such as buying a piece of machinery or a building. They have 216,000 enterprise customers, up 9%. 3,580 customers contributing more than $100,000 in a calendar year, up 23%. Online average monthly churn 3.1%, down 50 bips. Monthly churn is just a way of saying people who stop using Zoom. So 3.1% stop using Zoom. It was 3.6% last year, because 50 bips is equal to 1/2 of 1%. Their online monthly recurring revenue for customers who've been members for at least 16 months was 72%, up 7% from the prior year. Their guidance for the second quarter is revenue of $1.1 billion, net income of $405 to $410 million, which gives them an EPS of 104 to 106. Their target revenue for 2024 is $4.5 billion, earnings of about $1.6 billion, and EPS of 4.25 to 4.31. Let's take a look at their first quarter presentation. You could find this on their website. Zoom acquires WorkVivo to enhance the employee experience offering. Big companies like this are always acquiring other companies. Some acquisitions add lots of value to the shareholders, while others detract value. Expansion of Zoom IQ and partnership with Anthropic are core to our AI strategy. They're just another company jumping on the artificial intelligence bandwagon. Increase focus by simplifying communications and prioritization through insights and automation. Keep up with your day through summaries. Reduce time creating and sharing content. Manage shifting priorities effectively. Improve connections. Have better alignment and outcomes for better human connections. Get more done while meeting with your team. Find project context and shared work faster. That's a weird sentence. Automatically find the best times and ways to collaborate. High quality CX. Agent insights and assist to improve performance and strengthen customer interactions. Balance agent workloads, improve performance, reduce agent churn. Anthropic's AI model to bolster Zoom's federated approach by integrating with Zoom's platform, starting with Zoom Contact Center. It looks like Major League Baseball is a partner with them, also Virginia Tech, Plan Manager, and Venture HR. Q1 milestones. Non-GAAP gross margin of 80.5% exceeds target. Online business stabilizing. Zoom Phone reaches 10% of revenue. Let me know in the comments if you use Zoom Phone and how you like it. Continued top-line growth with positive trends in enterprise and online. Revenue up slightly from last year, $1.07 billion to $1.1 billion. Enterprise revenue up 13%. Monthly churn is down from 3.6% to 3.1%. A 9% growth in enterprise customers, 112% revenue growth for enterprise customers, and customers who spend over $100,000 in a year is up 23%. Growth in the Americas is up 8% from 728 million to 785 million. That's North and South America. EMEA is down 8%. Europe, Middle East, and Africa. And Asia Pacific is down 5%. The percent of their revenue in the Americas increased from 68% to 71%. So outside the Americas, business is declining. Their GAAP gross profit is 76%, up 50 basis points. R&D is 19% of their revenue, that's up 5.5%. Sales and marketing is 38% of their revenue, up about 4.5%. General and admin expenses is 18% of their revenue, up 7%. Their operating profit is below 1%. That's for GAAP. For non-GAAP, it's 38%. Non-GAAP excludes things like stock-based compensation. That's why the percent is higher. Effective tax rate 64%. That's kind of high. That's a growth of 43%. Non-GAAP is 22%. That's more normalized. A growth of 2.5%. But you do really need to look at GAAP. The items that they strip out in non-GAAP are real items. They're real expenses. Their RPO, remaining performance obligation, this sums up deferred revenue and future unbilled revenue. And that is up from $3 billion to $3.5 billion. Deferred revenue is when you receive payment for a product or service before you deliver it. So if you pay for 1 year of Zoom up front, that's considered deferred revenue on their balance sheet. So for example, say you paid for a year of Zoom up front. Just to make it easy, say you paid $120, $10 per month for 12 months. That's deferred revenue. It sits on their balance sheet until you use their product. So each month you use Zoom, they take $10 off their balance sheet and book it as income onto the income statement. And it really adds up when you have millions of customers doing this. So you have a lot of revenue that they can't book yet. It's good for cash flow because the company receives the cash, so their cash goes up, but they have to make another entry, which is deferred revenue. So cash goes up and liabilities goes up because deferred revenue is a liability. But they have a lot of unbilled contracts, over $2.1 billion, which is a good amount more than deferred revenue. Their deferred revenue went up 3% from the prior period last year. Unbilled revenue up 28%. Total RPO up 16%. Most of their RPO is current. So in the example for deferred revenue, if you bought 1 year of their service, That's current deferred revenue because you're going to use their service within 12 months. But say you pay for 5 years upfront for Zoom service. Only 1 year would be in current and 4 years would be in non-current. So if you gave them $5,000 for 5 years, only $1,000 would be in current deferred revenue, $4,000 would be in non-current deferred revenue. Their current RPO is up 9%, non-current is up a lot, 29%. And of course, total is still up 16%. Because the dollar amounts are the same in each quarter. You see 29.90, 29.90, 34.82, 34.82. It's just slicing it up a little differently on this chart. Strong cash flow in Q1. Cash balance is up from $5.4 billion to $5.6 billion. Operating cash flow $418 million. Free cash flow $397 million. Operating cash flow margin is operating cash flow over revenue, and that's 38%. Free cash flow margin is 36%. That means they convert 36% of their revenue to free cash flow. It seems pretty high. You always want to compare these numbers to other companies and compare it to Zoom in prior quarters. That's how you get a better sense how well they did for the first quarter. Here's their outlook for the second quarter and full year 2024. Revenue outlook in the second quarter, $1.1 billion. Full year, $4.5 billion. They expect shares to go up from 307 million to 308 million. Second quarter EPS about 105. Full year about $4.30. That's earnings per share. The way you calculate earnings per share, it's net income for the entire year over 308 million. These numbers are non-GAAP since they strip out lots of expenses to calculate non-GAAP. One platform delivering limitless human connection. Zoom One, Zoom Developers, Zoom AI, Zoom Contact Center, and Zoom Spaces. Drive impact with Zoom IQ and federated approach to AI. Empower modern collaboration. Expand solutions to new departments and industries. Sounds exciting, I know. Here are some quarterly numbers, and they give you 8 quarters of information. Q2 2022 up through Q1 2024. Revenue is not really increasing that much. It was $1.02 billion, now it's $1.1 billion. It is down a little from the prior quarter, but quarter over quarter, if you compare it to Q1 2023, it is up. Revenue is up every quarter when you compare it to the prior year's quarter. Up 54%, that's big. 35%, 21, 12, 8, 5, 4, 3. You see a trend here, right? It's going down. Soon it's going to be negative. Operating income was close to 300 million, but it keeps going down as well. It was negative last quarter. Now it's only 10 million. So this is what they strip out when they calculate non-GAAP. Stock-based compensation and related payroll taxes, acquisition-related expenses, restructuring expenses, and net litigation settlements. So they stripped out 130 million in Q2 2022. This most recent quarter, they stripped out 400 million. Their actual GAAP operating income was 10 million, but their non-GAAP operating income is 422 million because they add back this 413 million. That's how they do it. That's how they deceive investors. Anytime you see non-GAAP or adjusted, just think twice before you believe the numbers. Operating cash flow is strong, 419 million, up a lot from the prior quarter. In the past 2 years, it's their second best quarter. Only Q2 2022 was higher. So that's a good sign. Operating cash flow is an important metric to look at. They don't spend much in CapEx. Technology companies usually don't spend that much in CapEx. Manufacturing companies spend a lot in CapEx. Oil and gas companies spend a lot in CapEx. But software companies, not so much. Free cash flow, 400 million, more than double prior quarters. It was the highest in Q1 2023 at 500 million. Deferred revenue is the number to look out for. That is up from 2022. It was highest in Q2 2023. Unbilled accounts receivables is the highest ever at 100 million. That means they're extending credit to customers. You obviously don't want to get too loose in extending credit because people might not pay you. RPO is the highest ever at 3.5 billion. Customers spending over 100K is the highest ever at 3580. From these big customers, the percent of revenue they contribute is 29%. That's the highest percentage they've ever had. They have the most enterprise customers ever at 216,000. The revenue from enterprise customers is 57%. So 86% of their customers are big customers. Only 14% are regular people like me and you. Their monthly churn is going down. That just could mean they have less customers to churn out, or they're just providing a better service. It's down to 3.1%. It was 4.3% 2 years ago. It looks like they haven't released their 10Q yet. They release an 8K. But this report still provides us their financial statements. Here's the balance sheet, which lists the assets, liabilities, and equity. This is the accounting value of the company. And this report shows us the first quarter of 2024 versus the fourth quarter of 2023. I know it's kind of odd because they have a weird accounting year. April 30th, 2023 is the first quarter of 2024 because their accounting year ends 1/31/2024. Whatever year the last quarter ends in is their fiscal accounting year. And the first section of the balance sheet is their assets. U.S. companies first list current assets, then non-current assets. It's listed in order of liquidity. The asset that can be converted to cash the quickest, so that means cash will be on top because there's no conversion, it's already cash. It's down a little bit from last quarter. Last quarter was 1.09 billion, now it's 1.03 billion. Marketable securities is similar to cash. It's usually short-term investments like treasury bonds. That's up from 4.3 billion to 4.6 billion. Accounts receivables is how much other companies owe them. So they extended credit to these other companies. And that's up from 557 million to 590 million. This is when a company defers expenses that are related to acquiring a new customer or new business. That's down from 223 million to 209 million. Eventually, they're going to expense these items, which means putting them on the income statement and recording an expense. When you see deferred, they're just delaying things. They're delaying the expense. It's a way to avoid showing a big loss in one accounting period. That's why they delay things. Prepaid expenses are similar. This is when a company makes an advance payment for a product or service they're going to receive in the future. When they eventually receive the product or service, then they'll take it off the balance sheet and book it as an expense on the income statement. Some companies prepay rent, so they pay for a year up front. They can't book the expense until that month occurred. So if they pay for 1 year of rent up front, say rent is $10,000 a month, that's $120,000 they pay their landlord. They put a prepaid expense of $120,000, but each month they take $10,000 off the balance sheet and put it onto the income statement as an expense. It smooths it out. They can't put the entire $120,000 on the income statement even though they paid their landlord because they haven't used the space yet, their facilities. Once they use it for the month, then they can record the expense. Current assets are assets that can be liquidated into cash within 12 months. That's 6.6 billion, up from 6.4 billion. Non-current assets, here's more deferred contract acquisitions, 166 million. That's down from 180 million. Property and equipment, like their headquarters, 255 million, up a little bit. Operating lease right of use assets, 75 million. That's down a little from last quarter of 81 million. These are assets they lease from another party, but it's recognized on their balance sheet as if they own it. That's why they report an asset. Since they're leasing the asset, they owe money to somebody, the lease payments are down here, 68 million. Strategic investments, 452 million. I'm not really sure what this is. If I looked at their 10K or 10Q, I could probably figure it out. This could be related to their investments in AI. Goodwill of 300 million, up a lot from last quarter. This is the premium you pay when you acquire another company. Deferred tax assets, 532 million. A company might get deferred tax assets on their balance sheet when they overpay taxes in the past. Eventually, they can use this asset to decrease their taxes sometime in the future. Other of 180 million. Total assets, 8.5 billion, up from 8.1 billion. Liabilities is what the company owes. Current liabilities are what they owe within 12 months. Accounts payable, 16 million. This is what they owe other companies for buying on credit. That's up from 14 million. Accrued expenses, $500 million. This is when a company incurs an expense but hasn't paid it yet. Deferred revenue, 1.3 billion. This is for all the people who pay upfront to use Zoom for a year. Total current liabilities, $1.8 billion, up from $1.7 billion. Non-current liabilities, deferred revenue of $28 million. So most people just pay for 1 year of Zoom up front. They don't pay for multiple years, as you can tell. It's only $28 million for non-current deferred revenue. Operating lease liability, $68 million. That's what they owe on the right of use asset. And $71 million of other. So total liabilities is $2 billion, up from $1.9 billion. Let's look at their equity section. Equity is assets minus liabilities. It's the value of the company according to the balance sheet. Common stock of $298,000. This number is kind of meaningless. Each share of stock is assigned a par value. The par value is usually a penny or a tenth of a penny. It's just a way for the company to keep track of the number of shares out there. Additional paid in capital, $4.4 billion. That's how much money the company raised from issuing equity. Accumulated other comprehensive loss of $35 million. These are their unrealized losses. Retained earnings of $2.2 billion. This is the sum of all their prior net incomes. Total equity, $6.5 billion. Liabilities and equity, $8.5 billion. That equals total assets. As you can see here, $8.5 billion. Let's look at their income statement. $1.1 billion of revenue, up a little bit from last quarter. Cost of revenue is only $264 million. Gross profit of $841 million. They have really high gross margins. They spend a lot in R&D, $200 million. Sales and marketing, $420 million. General and admin, $200 million. Operating expenses, $830 million. They have almost no operating income. Last quarter it was $187 million. A gain of $2.3 million from strategic investments. Still not too sure what that is. Last quarter they had a loss of $36 million. Other income of $31 million. Last quarter was a loss of $7 million. Income before taxes, $43 million, down a lot from last quarter. $28 million of taxes, so they have net income of $15 million. Last quarter was $114 million, so their EPS is only 5 cents. Last quarter is 38 cents. Shares outstanding have gone down from 299 million to 295 million. Diluted shares outstanding is 304 million. If all the convertible securities converted to equity, they would have 304 million shares outstanding. Let's look at the statement of cash flows. It's broken out into 3 sections: operating, investing, and financing. Operating is first. The point of operating cash flows is to convert net income into cash, because net income is your accounting profit or loss. It's not actual cash. So to do that, we start with net income of $15 million. We add back stock-based compensation, because that's a non-cash item on the income statement, $280 million. Lots of stock-based compensation. We add back all non-cash items on the income statement. $73 million of amortization deferred contract acquisition costs. $24 million of depreciation and amortization. $22 million of deferred income taxes. They posted a gain in investments. We minus that out here. They passed through an expense of $15 million for accounts receivable allowances. That's just how much money they feel they won't receive from their accounts receivables. Then we have to adjust for changes in working capital. They extended $29 million of credit, meaning they sold product but didn't receive cash. So it's a cash outflow of $29 million in this accounting period. But when they pay for those items, it'll be a cash inflow in that accounting period. A cash outflow of $6.7 million in prepaid expenses. A cash outflow of $46 million in deferred contract acquisition costs. It looks like they used accounts payable, $2 million. That means they received a product or service but didn't pay for it. That's a cash inflow. A cash inflow of $25 million on accrued expenses. They received a lot more Zoom signups, $53 million in deferred revenue. Even though they reported an accounting profit of $15 million, they actually generated $418 million of cash flow. In the investing section, they purchased $768 million of marketable securities. So these could be bonds, treasury notes, commercial paper. $560 million of marketable securities matured. It looks like they spent $22 million of property and equipment. They spent $51 million on strategic investments. And that acquisition we talked about earlier, they spent $199 million. So in their investing section, they had a cash outflow of $480 million. Last quarter was a cash outflow of $42 million. Let's look at their financing section. They received $4.3 million from the exercise of stock options. They received $2.8 million from employee equity transactions. This is when employees buy stock in the company. Last quarter, they bought back $132 million of common stock. This quarter, they didn't buy any common stock. So they had a cash inflow of $7 million in their financing section. Last quarter, they had a cash outflow of $130 million. When you sum the three sections, operating, investing, and financing, they had a cash outflow of $58 million. Last quarter, they had a cash inflow of $340 million. That's the end of the video. Let me know your thoughts. Did I give you enough information about Zoom? Leave a comment, subscribe. Talk to you soon.